Are you interested in learning the secrets to building a $991 billion empire? If so, you're in the right place. Today, we're going to dive into the 10 investment principles of Charlie Munger, the legendary investor who helped build Berkshire Hathaway into one of the most successful companies in the world. By understanding and applying these principles, you too can improve your investment skills and potentially achieve great success in the world of finance. So, are you ready to learn from one of the best in the business? Let's get started. Rule number 1. Invest in yourself. Charlie Munger believes that investing in yourself is the best investment you can make. You should always be learning and expanding your knowledge. This means reading books, attending conferences, and seeking out mentors. Munger himself is an avid reader and reads multiple books per week. He's also known for his love of interdisciplinary learning, meaning he studies multiple subjects to gain a broader perspective. To invest in yourself, you could pursue formal education, take courses, attend seminars or conferences, read books, and seek out mentors who can guide and advise you. Munger himself is known to have a wide range of interests and knowledge, including psychology, economics, history, and philosophy. He has said that, "You must know the big ideas in the big disciplines, and use them routinely, all of them, not just a few." Most people are trained in one model, economics, for example, and try to solve all problems in one way. You know the old saying, "To the man with a hammer, the world looks like a nail." Rule number 2. Focus on a few big ideas. Munger advises that you should focus on a few big ideas and ignore the rest. By doing this, you can avoid distractions and stay focused on what's important. Munger himself is known for his focus on investing in great businesses with strong competitive advantages. He's also a big believer in the power of compounding, which he refers to as the eighth wonder of the world. To identify the big ideas worth focusing on, you could use tools like SWOT analysis, strengths, weaknesses, opportunities, threats, and Porter's 5 forces: competition, suppliers, customers, substitutes, new entrants, to evaluate the competitive landscape of different industries. Munger is known for his focus on a few big ideas, such as the power of brand loyalty, example, Coca-Cola, the value of financial services, example, American Express, and the stability of regulated utilities, example, Berkshire Hathaway Energy. Rule number 3. Have a margin of safety. One of Munger's most famous quotes is, "If you're not a little confused by what's going on, you're not paying attention." He believes that you should always have a margin of safety when investing. This means investing in companies with a strong balance sheet and a wide economic moat. Munger believes that by investing in great businesses with strong competitive advantages, you can minimize your risk while maximizing your returns. To have a margin of safety, you could use metrics like price-to-earnings ratio, P/E, debt-to-equity ratio, and return on equity, ROE, to evaluate the financial health of different companies. Munger advises that you should only invest in companies with a strong balance sheet and a wide economic moat. For example, Coca-Cola's brand loyalty and distribution network provide a wide economic moat that has helped the company maintain its market dominance for decades. Rule number 4. Avoid stupidity. Munger is a big believer in avoiding stupidity. This means avoiding mistakes that are easily avoidable. Munger believes that many investors fail because they make simple mistakes that could have been avoided with a little bit of thought. He advises that you should always take the time to think things through and avoid impulsive decisions. To avoid stupidity, you could use a checklist approach to decision-making, where you systematically evaluate different factors before making a decision. Munger advises investors to avoid mistakes that are easily avoidable by doing their due diligence and thinking critically. For example, when evaluating a company's financial statements, you could look for red flags like aggressive accounting practices or excessive debt levels. Rule number 5. Be patient. Patience is key according to Munger. He believes that successful investing requires a long-term mindset. Munger is known for his investment in Coca-Cola, which he held for over 30 years. By having a long-term perspective, you can avoid getting caught up in short-term market fluctuations and focus on the long-term potential of your investments. To be patient, you could use tools like dollar cost averaging, where you invest a fixed amount of money at regular intervals, regardless of market conditions. Munger recommends taking a long-term view and focusing on the underlying fundamentals of the companies in which you invest. For example, Berkshire Hathaway's investment in Apple has benefited from patient holding, as the company has grown steadily over time and become one of the most valuable companies in the world. Rule number 6. Have a latticework of mental models. Munger is a big believer in having a latticework of mental models. This means having a broad understanding of multiple subjects and using this knowledge to make better decisions. Munger believes that by having a broad range of knowledge, you can connect ideas from different fields to create new insights. To develop a latticework of mental models, you could use tools like mind mapping, where you visually connect different ideas and concepts to create a holistic understanding of a topic. Munger's interdisciplinary approach to investing draws on a wide range of mental models, including psychology, biology, physics, and mathematics. For example, when evaluating a company's management team, you could use concepts from psychology to understand their motivation, personality, and decision-making style. Rule number 7. Know your circle of competence. Munger advises that you should know your circle of competence. This means understanding your strengths and weaknesses and investing in companies that fall within your circle of competence. By doing this, you can avoid making mistakes and focus on what you do best. To focus on your circle of competence, you need to understand your strengths and weaknesses as an investor. Munger advises investors to focus on what they know best and avoid investing in areas outside of their circle of competence. For example, if you have expertise in technology, you may want to focus on investing in tech companies rather than trying to invest in other industries like healthcare or real estate. One way to identify your circle of competence is to conduct a personal SWOT analysis, which involves evaluating your strengths, weaknesses, opportunities, and threats. This will help you identify your areas of expertise and where you may need to improve your skills or knowledge. Rule number 8. Be rational. Munger is a big believer in rational thinking. He advises that you should always think critically and objectively when making investment decisions. Munger believes that emotions can cloud judgment and lead to poor decision-making. By being rational, you can avoid making emotional decisions that can lead to costly mistakes. To prepare for change, you could use scenario planning, where you create different scenarios for how the future might unfold and prepare for each one. Munger advises investors to have a flexible mindset and be ready to adapt to changing market conditions. For example, when evaluating a company's growth potential, you could consider how emerging technologies or demographic shifts might impact their business model. Rule number 9. Stay humble. Humility is important according to Munger. He believes that being humble allows you to learn from your mistakes and improve as an investor. Munger himself is known for admitting when he's wrong and learning from his mistakes. He advises that you should always be open to learning and be willing to admit when you don't know something. To stay rational, you could use tools like decision-making frameworks, where you evaluate different options based on their expected value and probability of success. Munger advises investors to avoid cognitive biases like overconfidence, confirmation bias, and sunk cost fallacy. For example, if you are considering investing in a new company, you could use decision trees to evaluate different scenarios and calculate the expected value of each option. Rule number 10. Collaborate with like-minded people. Munger believes that collaborating with like-minded people can lead to great success. He advises that you should surround yourself with people who share your values and have similar goals. By doing this, you can leverage each other's strengths and build a strong team. To understand both micro and macroeconomics, you could use tools like supply and demand analysis, macroeconomic indicators, and industry analysis to evaluate different investment opportunities. Munger advises investors to have a broad understanding of economics and to consider the interplay between different economic factors. For example, if you are evaluating a company in the energy sector, you could use macroeconomic indicators like GDP growth and inflation to evaluate the demand for energy, while also considering microeconomic factors like the company's cost structure and competitive landscape. And there you have it, Charlie Munger's 10 rules to building a $991 billion empire. Munger's principles of investing are rooted in a long-term mindset, a focus on fundamentals, and a commitment to learning and self-improvement. By following these principles, you can build a successful investment portfolio and achieve your financial goals. Thank you for watching, and we'll see you in the next video.